Continuity Conversations on RealAgriculture.com is brought to you by 337. Find out more by going to 337.ca. It's time for another episode of Continuity Conversations with the CEO of 337. It is Derryn Shrosbree. Derryn, how are we doing?
Very good. Thanks, Shaun. How are you?
Pretty good. Okay, so
Yes.
today we're going to talk about one of the things that farmers hate doing maybe the most. We're going to talk about taxes, okay? And step 5 in the continuity process is how much personal income tax do you want to pay in April? My answer to that, Derryn, is I don't want to pay any, but is that the right attitude to have?
Certainly. Absolutely. Yes, it is the right attitude to have. I think that paying taxes is important because we do need roads and other bits and bobs. I don't mind paying some tax, like corporate tax between 9 to 25%. That seems reasonable. We get value for that from a societal standpoint. I think paying 54% tax is kind of egregious. I don't perceive to see the value of that 54%. I was up this morning. I have a vegetable farm. It's April right now, and the spinach and the kale went in. So that was at 5:30 this morning. And I didn't see anyone from the government show up for the shift. There was myself and three Mennonites, and we were cranking. And that was at 5:30 this morning. Sun was coming up. It was a beautiful day. But at the end of the shift, at the end of the day today, after this call, I'm going back outside. I'm pretty sure the government's going to put their hand out and be like, can I have half your money? To which I'm going to be less than responsive to that particular request. So I think there is definitely some portion of tax needs to be paid. I'm okay with that. The Bible says 10%. We're between 9 and 25. I'm okay with that, right? 54, I'm out. So how do we fix that little quandary of 54%? So there is a way. And it is, let me just say this very carefully. It is 100% legal and has been done for a long, long time. It is not new. It's just news to you. All right. So let me put that caveat out there. So this is how you do it. How do you not pay personal income tax in April? It's fairly straightforward. Your farm, your corporation, your farm, your business creates corporate retained earnings. It makes money. Right? That money you then use, generally speaking, if your farm is in the corporation. If your farm is personally owned, acreage is personally owned, the tax is a little different. But let's just use an easy example. Let's say you own a farm and all your land and your quota, or whatever the case may be, is in a corporation. And you're running your farm, et cetera, et cetera. But you need money for gas and groceries. Obviously, you can put some of the gas on the farm, et cetera, et cetera. But stay with me in the macro. The macro is this. You need to take money out of your corporation to go on trips, school, I don't know, gas, groceries, et cetera, et cetera. So you have to take money out to live. Let's say that your living expense is $100,000. Easy math. It's 100 grand, right? So you got 100 grand, you pull it out of your corporation. What happens, Shaun?
You got to pay tax.
You got to pay tax. Yeah, depending on what province, you can pay between 10 to 30, 40%, depending. So once again, I'm just going to do this on easy math. Everyone's going to come back at me and be like, oh, but your numbers are wrong. No, they're not wrong. Stay with me in the macro. So if you take 100,000, I know, because the accountants, their heads are going to explode, right? But just follow the narrative. So if you take 100,000 out of your corporation, you've got to pay tax. Let's just use easy math and say it's $30,000 per 100, which is about right in most provinces. So if $100,000 goes to the government, you take 100 grand, and that's April. Right now it's April. So 99% of us are doing exactly this. All right. So you're like, okay, well, I don't particularly like that, nor do I see any value. Right? We follow my flow so far?
Yep.
So how do we get the 100 grand out of the corporation and not pay personal income tax? There is a way. The corporation, your farm, would take $100,000 and write a check to an insurance company that's buying permanent whole life insurance.
Yep.
The $100,000 of premium goes to the insurance company. So there's 100 grand that's gone. The farm then owns a life insurance policy. Generally, it's 10 times the value of the premium. So you paid 100 grand, you get $1 million policy back. That's kind of handy. And we'll figure out what we use that for in the next conversation segment. So we've done one transaction. Transaction number one is $100,000 went from the farm, boom, to insurance company.
Yeah.
Farm gets life insurance policy, transaction number one. That in and of itself is very handy, but not that interesting. Part that is interesting is we can go to a bank, any bank, like Scotiabank. Let's just use that. Scotiabank, for example, and say, hey, Scotiabank, can I please borrow back $100,000? The bank says, sure. They take the policy as collateral. You pledge it as collateral. You get $100,000 back personally. You take the 100 grand personally. That's interesting because loans are not taxable. So
Mm-hmm.
transaction two is a loan comes back to you personally. You have to pay that loan back, Shaun. But when do you pay it back?
Well, it's connected to life insurance, so it'd be upon death.
Yes, you pay the loan back when you die.
Yeah,
Therefore, that $100,000 is not taxable because you take it as a loan. So I've just saved you $30,000 in tax.
that makes sense.
You rinse and repeat that every single year for as long as you do not want to pay tax for, which I presume is not 1 year. I presume it's for quite some time. And we
Mm-hmm.
can rinse and repeat that as you wish. So the two transactions is transaction one, 100 grand goes out, which you were going to spend on gas and groceries anyway. So why not buy an asset that can do amazing things? Farm owns it, pledges collateral, bank gives you back the 100. Essentially, it's a mortgage. You're basically just mortgaging your life insurance policy. That's how you don't pay tax in April. Personal income tax. Corporate tax, pay the freight. Like I'm all happy to pay corporate tax. That's a good thing. But personal income tax, you can after this hearing this conversation, it's kind of optional. So you choose.
Is there, does it have to be, you mentioned whole life, so it's got to be whole life?
Yes, because the banks won't lend against universal life, and obviously term has no value whatsoever. So
Right.
the only solution is participating whole life. And before you start like throwing your toys and be like, oh, I hate life insurance. I'm like, I hate life insurance too. But you know what I do like? Tax-free money. So it's just a tool in the toolbox. And combining the tool in the toolbox with another tool, put those together, you're getting something quite special, which is a much lower tax rate.
Now we can't have these whole life policies being connected to the transition plan for, say, off-farm kids or children, right? Because the loan is going to be paid out by the life insurance, and so we don't have like, or can you use those same policies?
Oh my goodness, you can indeed. Because now you can use $1. Not only are you using $1 twice, you can use $1 three times. Because think about this. You take out the whole life policy, and this is, by the way, continuity conversation number 4, 5, 6, 7. Like it's a little lower down, but we can address it now. So yes, think about this. So you take out the life insurance policy, it's paid for by the farm, you get the money back, right? So you're capital flat. You don't have a drain of, oh, I need inputs, I need to buy a bin from Meridian, yada, yada, yada. No, you get the money back. So 100 went out, 100 came back in. So you're going to use it for the same farm stuff you were going to use it anyway. But you now have this life insurance policy. Whether you use it for gas and groceries or reinvest in the farm, that's up to you. Or you can do both. But think about this. You died today. Yes, the loan gets paid off. In this example, it's 100 grand gets paid off, but the farm now gets 900 grand. You're dead. The on-farm kids get the acreage. The off-farm kids get the 900 grand.
Mm-hmm.
That means they still have supper together because the off-farm kids get cash. The on-farm kids get acreage and quota, right? So this solution not only sorts out your tax burden for April, it is vital for estate equalization. I
We're
mean, vital.
we're going to get into, treating the off-farm kids equally to on-farm in the next conversation, but
Yes.
one thing I do want to ask you is using life insurance outside of the tax strategy, but as a succession tool in the transition plan. Does that create an environment where everybody's sitting around waiting for mom or dad to die before they get any money?
Um, so some people do use death as their career path and their career plan. Yes, that's an individual's choice and it's not particularly good. I think that having open and honest conversations as fast as possible and as young as possible with the young folks shows that we're stewards and there's a continuity of stewardship through farming. So you cannot use my death as your career path. So that would be the first step to have that conversation with
Yeah.
folks, right? But yes, Shaun, to your point, 100%. Some people are like, oh, I'm going to sit back, just going to wait for you to die, and they're going to get
Yeah.
everything. It definitely, um, when you see the numbers, they are quite big. And yes, people can go down that road, but we have to nip it in the bud because otherwise, yeah, bad things will happen. Yeah.
What are some other tax considerations as a part of this process do we need to be thinking about?
Tax considerations, well, that's a pretty broad question. So it has to be, you don't need an accountant to vet it. You don't need a lawyer to vet it. It's a pretty standard thing. Don't forget that from a credibility standpoint, you're not facing some random dude who's a vegetable farmer. Your counterparties are one, let's use Sun Life as an example. That's a $50 billion company, and two, Scotia, which is a $50 billion company. Those are the people that have written the paper between them. So you can't look at me and go, oh no, that's too good to be true. Well, if it was, two $50 billion companies wouldn't do it. They wouldn't do it, right? But they do. So it's not a question of, oh no, 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 this doesn't work. Oh no, it works. It's just, you got to get your mindset around that. So from tax considerations, like I said, it's extremely old. It's been done for over 100 years. It's not new. Um, it's low risk, if any risk. I don't see any risk. We've never, and I've only done this for 17 years, continuity planning, so I'm just starting, so bear with me. Um, we've never, yeah, we've never been audited. None of our clients have ever been audited. It doesn't trigger audit. You're buying life insurance, which is extremely important for a farmer or for anyone, and you're using the company to pay for it. That's 100% legal. Like it's an asset class that has been around as long, if not longer, than mortgages. So there is no red flags here. It doesn't trigger the CRA into like a mind-blowing panic.
Yeah.
It's very bog standard. There are lots of tax things that you can do which will instantaneously trigger audit, which we can discuss, but we don't do.
We don't you avoid. So and the benefit of whole life is although more expensive from a premium standpoint in comparison to term, is the term has no value, like no equity value, whereas the whole life it actually does have a value component to it.
Yeah, it's great. I love the fact that you use the word expensive, right? Because whole life doesn't have an expense. There is no expense, right? Because that's the mindset shift you have to think of. Because when you say insurance, you go to expense. It's more expensive. It's not. It's actually cheaper than term. Because if you're using it properly, don't forget, what is the expense if you take $100,000, buy whole life, and I give you $100,000 back? What's the expense?
Yeah, I get your
There's no
point.
expense, right? Whereas term is lighting money on fire and trashing it because no one ever uses term generally. You don't die before the term is up. So term is pure cost. Like whole life insurance is pure asset class. So whole life is used as an asset class to create wealth, to equalize the estate, and to pay no tax. It does three duties. Whereas term, you buy a 20-year term, it runs out, you don't die, all that money is wasted. It's gone. It's useful if you don't have a lot of income that you can shelter, etc., etc. So yes, if you have no cash flow, term is better than nothing. But term is a temporary solution for a permanent problem because you're gonna die and you need all the stuff at the end of life. Term never steps up to the plate. Whereas a permanent solution for a permanent problem, aka death, you want to match those together, right? Hopefully that helps you a little bit.
It does. And just before we wrap up here,
Yeah.
whole life versus universal life.
Yes. Whole life, simple, easy to understand, pretty straightforward. It's I don't want to get too complicated. It is well, I'm a Fent guy. It's the Fent of, yeah, it is definitely the Fent of tractors, right?
Yeah, yeah.
Black combines, beautiful. So for me, it's either the John Deere or the Fent. So that's what it is. So universal life is extremely complicated, mathematically very, very tricky, and can go offsides fast because it is what's called self-directed. Self-directed means that the money that you can put investment components into universal life, it is it is sophisticated and complex. It has a use case, but for 99% of the time, universal life is not applicable to farming and to estate planning in the way we do it. There is a use case, but that's a full segment. If you want to get into the difference between those two, we can dive into them. But if you want straight up John Deere or Fendt, go for whole life. If you want something wildly esoteric, universal life, which comes with a lot of risk, is an option.
Derryn, thanks a lot for joining us here today. Really appreciate it.
Pleasure, Shaun. Always lovely to chat. Thank you so much. Ciao.